Good afternoon, everybody, and welcome to this edition of our Broker Moves Review for 5th of Feb. My name is Carl Capoligua. I'm the market analyst over here at Think Markets Australia, and it is a pleasure to be with you as we delve into everything broker-related for the past week. But before we do, the Think Markets difference, which is substantial, $8 flat rate trades, your own holder identification number, unlimited phone support, and of course, no hidden platform or subscription fees. 4 fantastic reasons to make sure your next ASX share trade is with us. The agenda for today is to have a look at all the big broker upgrades and downgrades for the week. We'll have a look at their price target changes and then focus in on a few stocks that made the news. We'll kick off with our upgrades. Now, don't forget, each broker has a rating from buy through hold, through sell, and sometimes in between, sometimes outside of. Pretty much what they think their clients should do with the stock in question, and often they'll have a price target as well, an expected valuation the stock could reach over the next sort of 12 to 18 months. And these are the ratings changes for the week. We had, for example, Macquarie upgrading Adbury, the construction materials manufacturer, from underperform to neutral, and they increased their price target from 245 to 305, and that's an increase of some 24.5%, which sounds fantastic, but that target price is actually 4.7% above the current share price right now. So it seems like a big jump, but the broker isn't exactly expecting too much more upside from here, and that's reflected in that rating of neutral. Having a look through the rest of the list, Amcor got an upgrade after their profit guidance, largely in line with expectations. There are a few brokers upgrading and downgrading, as we'll see on that one. This one was from neutral to buy, and really a very small decline in there on the price target, but still seeing about 11.5% upside. That's not too bad. We saw CSR go from neutral to outperform at Macquarie. A nice increase in the price target there by 17.6%, still about 7% upside seen there. Other notable moves, Fortescue, Credit Suisse, they had a view on the entire iron ore sectors. We'll see when we get to the stocks of interest, but this one, Fortescue going from neutral to outperform, 42.4% price target increase, but largely in line where the market is right now. A pretty big bump up there on Helios from sell to buy. Unusual for brokers to go all the way from sell to buy. Normally that might go to hold or neutral in between. And also a massive increase in the price target there by 63%, still 6.3% upside seen on that. And Wesfarmers is going from neutral to outperform at Macquarie with a nice increase in the price target, 0.7%, and still seeing about 8% upside in Wesfarmers by Macquarie. Looking at the downgrades now, not so lucky. Credit Suisse, as I said before, they did have some words to say about iron ore stocks. They downgraded this time BHP from outperform to neutral. Did increase the price target slightly, however, but that price target is still above the current price. Another one of the big ones there, Macquarie Group, going from neutral to sell at Citigroup. So a little bit of a cop that between the sort of big research houses there, and a small decrease in the price target as well. And that target is still well above the current share price. Origin in the news as well, as it had a bit of a profit warning, and that spooked a few of the brokers. A downgrade here from buy to neutral, and a large decrease in the price target there from Citigroup by 28%. Treasury Wine Estates going from overweight to equal weight, a downgrade from Morgan Stanley. And Worley Parsons, they had a profit warning out as well, not doing so well operationally. And we're going from outperform to neutral at Credit Suisse and buy to neutral at UBS, and price targets falling at each of those brokers by over 20%. A little bit of concern there. Western Areas, the nickel miner, out with some bad news last week, so Credit Suisse catching up on that one, outperform to neutral. Having a look at the price target increases, and this is where price target changed, but no rating changed. Amcor, we're seeing some price target upgrades from here, from Credit Suisse and Morgan Stanley, 4 and 5.6% respectively. It looks like a big one there from Afterpay by Macquarie, some 43.6%. From 97.50 to 140, but I do note that that price target is above the current price, hence the neutral rating there. Bluescope, they came out with some better than expected profit guidance, increasing their profit guidance for the first half, and we're seeing brokers react accordingly there with increases, small ones, however, from Citigroup, Credit Suisse, Macquarie and UBS, and still plenty of upside seen in the Bluescope price. That's quite encouraging. Definitely go check that one out. And then heading down the list, it's looking for interesting ones here. Flight Centre Group, one of those travel stocks, getting a nice bump up, about 13% there from Macquarie, but not a lot left in it. Hum Group, a small increase from UBS. That's the buy now, pay later flexi rent stock, and still plenty of upside seen in that one at UBS. That's probably worth noting there, 33.9% upside and a buy rating. Heading into the next page, and don't forget you can press pause on this recording and see if your stock's on the list. We'll keep moving for that reason. McMillan Shakespeare, we'll talk about that one a little bit later on. They had better than expected profit results. Nice price target increases there from Credit Suisse, Macquarie, and Morgan Stanley. Look at that, 32.41, 19.2% respectively. Still a bit of upside seen from at least 2 out of 3 of those brokers. Nick Scali had a profit result largely in line with their increased guidance. So, already ahead of market expectations in many ways, and we saw a couple of price target increases there. Origin Energy disappointed the market on the other hand. Heading into the last page here, ResMed getting a couple of small bumps, as did Seek. Seven West Media is a stock that does look pretty good, 40 cents to 50 cents, a nice bump up, still some upside seen on that one. And rounding out the list down the bottom there, Woodside Petroleum, a small increase from Macquarie, but still over 11% seen to the good on Woodside. Having a look at some of the decreases now, AGL Energy, as we'll see when we get to stocks of interest, they had a profit warning during the week, similar to the Origin one. They're in the same space. We've already talked about Amcor, CSL getting a couple of dips in their price target, so 3.1% down by Citigroup and 7.5% by Macquarie. And into the end, Worley Parsons, as we said, disappointed the markets and getting those price target downgrades from Citigroup and Macquarie. Okay, as we mentioned earlier, Credit Suisse came out during the week and upgraded their iron ore expectations for the next 3 years, increasing the expected price from what their original estimates were by about 45%, so a substantial increase in their expectations due to improving demand and supply fundamentals. Looking at BHP first, they said this could result in a 25 to 40% increase in the company's earnings over this timeframe. However, the broker preferred Rio Tinto, as it has a higher exposure to iron ore pricing. We did see that Credit Suisse downgraded their rating from outperform to neutral, whilst they raised the price target by $2. On Fortescue Metals Group, they upgraded their rating from neutral to outperform, and the price target went from $16.50 to $23.50. As we mentioned before, the broker likes this one due to its extremely low debt levels, strong production growth profile, and what is now an amazing dividend yield. We'll stick with Credit Suisse and go down to Rio Tinto down here. They raised their price target from 95 to 125, so a big pop-up. Retained their neutral rating, however. It is their preferred pick when it comes to BHP or Rio because of its higher exposure. And they said their increase in the iron ore price targets could result in a 40 to 60% increase in the company's earnings over time. Macquarie Group came out on Mineral Resources, which is an iron ore miner, but also has some lithium interests, actually. And they increased their price target from 42 to 45.80, retained their outperform rating. They were impressed with Mineral Resources' second quarter production results that came out during the week. They noted iron ore production was 16% ahead of their expectations, and spodumene, that's the lithium derivative there, also up about 11%, and they said that they saw improving production as a new mine comes on in the second half. UBS on Mineral Resources, a nice bump up in their price target from 41.90 to 44.60. They found some negatives in the report, to be fair, mainly due to COVID issues, operational issues, probably one-offs, and the broker therefore wasn't too fussed by it. They did maintain their buy rating, of course, and said that the outlook was positive and the projects remained on track. The chart we're looking at is Fortescue Metals. I had to pick one of those, and I picked Fortescue. It's in a fantastic uptrend. Long-term uptrend, I should say. The short-term uptrend is starting to come under pressure, however, and I'll be watching this very closely. It could continue in this sort of new medium-term downtrend, come back and test this long-term support. And I do think that would be your buy zone if you're waiting to get into Fortescue. If you've got it and you're a longer-term holder, well, the long-term trend is still up, so you would hang on to it. If you've got it and you're a shorter-term trader, well, short-term trend is starting to come under pressure, as I said, so you might want to reconsider your position there. But we'll treat it as a bit of a long-term investment. and therefore we'd be looking for buying opportunities if we get into that sort of 20 to 21 zone. What do the brokers think about it? Well, on average, we're a hold, 1 strong buy, 4 buys, 11 holds and 1 sell. And this has changed significantly over the last few months, really, as the price has exploded. And you'll probably see that start to switch around. If we do see a bit of a pullback, and it will probably swing back more to the green around there. Mean estimates about 21.54, which is pretty close to that range I was talking about, with a high of 32. Looking at the company's valuation metrics, and with a PE of 7.47, certainly doesn't look expensive. The PE growth ratio is a little high, but the outstanding item here is, without a doubt, it's 10.52% fully franked dividend yield, and some fantastic return on equity numbers as well. Having a look at another company it's got a pretty good return on equity number down there, 30.7%, is McMillan Shakespeare. Credit Suisse, they liked the update during the week. Obviously, the big fear was that there'd be a major negative impact on economic growth, and whilst there certainly was a blip in economic growth, it didn't stop car sales, and in particular used car sales, and the company has been able to benefit from that, and we can see certainly in the chart that the long-term trend has just started to switch back up as investors start to realise that the worst is probably behind this one. Short-term trend looks very good as well. Having a quick look at the brokers, that's what we're here for. Credit Suisse raised their price target from 10.60 to 14. That's a nice bump up, retained an outperform rating. They were very happy with the first half profit guidance, noted the recovery in leases tracking better than expected as vehicle sales normalise post-COVID. Sees continued strength in FY21 and FY22, also shaping up as a potential upside year. Macquarie raised their price target from 9.11 to 12.93. They were still neutral on it, however. They did like the ongoing recovery in motor vehicle markets, driving increased novated lease sales. Their profit of 42.7 million was well ahead of the brokers' expectations, and the outlook, they believe, is too conservative. They think there's plenty of upside there, and they increased their EPS estimates for FY21 by 11.5%. As a result, Morgan Stanley increased their price target from 12 to 14.30, retained their overweight rating. They were impressed with the guidance, notes it was well ahead of the brokers' expectations, and the company, once again, is a bit conservative in their estimates for FY21, and operating conditions can continue to improve, and therefore they have increased their net profit after tax expectations by 6%. Not too many brokers reporting on this one, but we do have an average of buy with 2 buys, 2 holds. Must have just somehow skewed that model to the buy side. Mean target of 12.61, which I must admit is a little bit below the current price and upside of about 14.30. Enterprise value to revenue, very, very good. PE ratio, I wouldn't call that expensive at all. And with a PEG of 0.97, it is quite attractive actually, because anything below 1 is the rule of thumb, is very good. Dividend yield, very nice indeed at 4.3%. And price to cash flow, quite good. Return on equity, as I said, quite good. So I'm pretty happy with that one. AGL, well, we couldn't get a bigger contrast, could we? Between McMillan Shakespeare and AGL, the first thing that strikes you is this very well-established long-term downtrend, a very well-established short-term downtrend, and we keep making these lower peaks and lower troughs. And why is that? Well, AGL is in a bit of trouble. The brokers are telling you that. 6 sells, 4 holds, and just the 1 buy. I'm not sure who that might be. Not on screen. Citigroup, they are neutral, lowering their price target. Poor management decisions with respect to onerous wind power purchase agreements as eroding shareholder value. Credit Suisse lowered their price target from 11.10 to 9.50, retained an underperform rating, and the write-downs and impairments are on the back of those contracts as AGL wrote down the value of the contracts. Macquarie lowered their target from 11.63 to 10.86, retained an underperform rating. They anticipate the operating environment will continue to deteriorate as pricing remains subdued and costs remain stubbornly high. And UBS went from 11.60 to 11, retained a sell rating, so they're not pulling any punches there. Expect earnings to continue to decline and risks remain skewed to the downside. So we are seeing some coincidence of what the brokers are saying, at least what the charts are doing. Having a look at the fundamental numbers, well, that is incredibly low. The PE actually isn't that low, so that's there's still some downside there, one would suggest. There's no growth because I'm pretty sure they didn't grow their earnings in the last financial year. And the dividend yield of 7.5% might be under pressure, I would suggest, given what's going on with the business. Price to free cash flows seems very, very low, however, and price to book value is very, very low. Return on equity, unfortunately, is also very, very low. So certainly not one of those that you look at it and go, well, that's, the brokers have got it wrong on this one. I think there's plenty of question marks over the fundamentals on that. The brokers have confirmed it, and the chart looks pretty awful. This one here, I wouldn't say the chart looks as awful, but we can see how important these areas of long-term resistance are from the moving averages. Dynamic resistance, which means it keeps moving, and once again, once you hit those levels, there's if you can't hold up there and push through, there's a pretty good chance you're heading down again. Citigroup downgraded Origin from buy to neutral. They'd lowered their price target. The broker was not impressed with the downgrade during the week. And again, the same problem as AGL, management mistakes with respect to hedging. And we've got a little bit of a typo there because that was a Citigroup one from earlier in the week, and I can assure you this is the one from later in the week, so we can prove it by saying 661. So they actually increased their price target earlier in the week and retained a buy rating, and then later in the week after the profit downgrade significantly lowered their price target and went to neutral. It's funny how it happens. Look, we actually got another one here from Credit Suisse, so we can see Credit Suisse lowered their price target from 570 to 510, and then after the downgrade from 510 to 480, so they were already on the way down. A neutral rating there. They didn't like, obviously, the announcement. It was 20% below the broker's expectations. And Macquarie Group, they only commented one this week, but they did lower the price target from 569 to 535, retained their neutral rating. They were concerned about weaker emerging markets demand. In combination with the company's profit downgrade, the broker lowers expected earnings by 25% in FY21, but more modestly for subsequent years. Interestingly, we've still got two strong buys, 4 holds on the stock. We've got a mean target of 574, so that's giving it some upside. And looking at some of the fundamentals, this PE is concerningly high given we've got a blip here, so clearly they didn't grow their earnings last year. Whilst that is not too pressed, it's a reasonable number, and so is that. I'd be disappointed by some of these numbers down here. So it's not a lock. It's certainly not a lock where you just go, that's one I want to own. And that's borne out in the broker recommendations and the chart as well. Okay, thanks for joining me today. Plenty more news and updates in our market news section of the website. You can follow me if you like. All the Think Markets handles on Twitter. On Monday, I'm back for the weekly Think Tank. You do need to go to the webinars section of the website to register for that, as you do need to register for our 3 small cap stocks to watch in 2021 on Wednesday, and Ask the Experts next week, where you can bring me your portfolio and I'll give you a fundamental and technical. Of course, I think Markets is a regulated Australian broker. We do have some products that could see you lose more than your deposits, so please read this disclaimer carefully, and if you have any questions at all, give us a call or consult the website for further details. It's been a pleasure being with you today. All the best for your trading. Until we catch up again, bye-bye for now.